Colleagues, it's Tusanang PM Sebata. I'm just doing a quick recording of my analysis, mainly fundamental. I haven't done much technical or the options executions on this one. I'll focus on the fundamental analysis only. I looked at the sector on cigarettes. Yes, I did some background work before this to pick which sector I thought was of interest, and I came up with the cigarette tobacco sector. And yeah, using this FinViz website, there are not many of them, the big ones really. I don't really bother with the little ones. I just came up with these top three, and Philip Morris, Ultra Group, and British American Tobacco. I did not put much focus on British Tobacco. Their financials are a little bit of a hassle, and it's UK based, so I just left it out, but it's the third biggest one. Overall, it doesn't show any major difference from the other one, so yeah. I analyzed these two and compared them. That's what I'm going to take you through now. So first up, let's just look at PM. I don't care about the daily that much. You'll notice that since mid-January, July last year, it's been going down. It's been tanking basically. And if you come down here, you'll realize that it has dropped about 32%. The other one is about 20% or so. So in all, I can say basically cigarette companies have really hit it off on the downside. They've had a bad time. So from a value perspective, this is the time to start looking, because there has been blood on the floor here. It's time to look, and that's what I did. And just for completeness, the other one, MO. Also, it has taken a slighter knock, unlike PM, but yeah, it did also move here. It's showing at 17, I'll call it 20 down. So you can tell it's been some knock downwards, and that was my motivation for going after this one. Looking at the financials and this summarized data, the fundamental summarized data, it's still a strong company. They have good figures here. Return on assets, return on equity, return on investment. It's great, especially return on equity. It's wow, 72%. That's some serious money. It's mainly driven by the debt. They have lots of debt, which they use to bring down their cost of capital, then increase the returns. It's a good strategy. It works for them. This is a mature company. They can afford that. And they also, but with all this given, the stock have been falling this past 2 years. So there is something there. I haven't gone in dig a little bit deeper on why it's falling, but there were issues, and these guys are always having issues with legal issues about court cases and being sued for their cigarettes. It's not a great industry, but I'm an investor. I'll go and short it if need be, or buy it if need be. So I'm indifferent on that one. When it comes to the investment, I just invest the way I see the market going. And just looking at, I'll start off with PM, because it has some funny thing which I saw when I was doing the analysis here. You'll notice that it's got a negative return on equity. When I go to the financials later, you'll notice that the equity is negative. That's why we do not have debt to equity ratio here, unlike the other one. But I will touch that one a bit on when I look at the actual financials. These two are both good dividend payers, 5.7, and the payout ratio for Philip Morris is 103%. So they paid more than they made. So they went and borrowed money to increase, to add to the amount which they were paying as dividend. It's a little bit funny, but yeah, that's the way what they did. Instead of cutting down on dividends, Philip Morris went and borrowed money and paid it over to the shareholders. Personally, from a corporate finance perspective, I would think maybe the shareholders were better off borrowing the money from the market themselves than getting the money borrowed and the dividends being taxed. Doesn't make sense for me. It's a red flag there. And also you notice this number here on dividends. It's 5.72%. I found it strange when I looked at compared it to Altria. You'll notice that this one is borrowing money to sustain that 5% dividend. And when I come to Ultra Group, they also paying 5, but this time it's 5.2%. Big difference. They are not doing the same strategy of borrowing money to pay to the shareholders. Their payout ratio is way lower, less than half. The other one's payout ratio is more than what they made. So I think Philip Morris is trying to keep up with its closer competitor. But in general, I don't like that strategy where they are now retaining funds back. So it's basically Philip Morris having a strategy of saying, we are a dying company, we are just giving you back your money slowly. It's it's stretching it, I know, but that's what they're doing. If they are consistent with it, that's what I'll give it to them. And coming to the operating margins, both operating margins are good. They are, for Ultra, it's about 40, the other one is 39 or so. So yeah, their financials, they're strong. All the numbers are strong. Expected growth is one thing which I don't believe. They have an expected growth. If you take the PE and the PEG ratio and divide them there, you get an expected growth rate of about 11%. I don't buy that. And the expected earnings growth in the next year, expected growth in the next year, expected earnings growth is about 8% to 9%. Earnings per share for the next 5 years, it's about 10%. I don't buy that 10%. Remember, I'm doing this evaluation, so there will be lots of my inputs to it. I don't buy that one, but that's what they are recording. But we'll see that as we flip to the actual analysis, which I did. My key thing with this market is that I still have to understand why it dropped. Is it something temporal, just cyclical, and the market is going to go up, or is this the start of the end of the cigarette business? So that's a big factor there for me. Going into the actual analysis, okay, on my cost of capital, they don't have much of capital, but just to step back, I was a little bit lazy when I did these comparisons. My intention was to build up something which I'm going to use next year around Feb. So I used the last annual reports. I did not factor them for the quarterly reports which have since come. So this financial data is almost about a year old now, about 9 months old. But these cigarette companies are not changing that much. It's not major changes. But if one wanted to do it correctly, you would have to update these figures, which is easy to do, but I was lazy to do that. Don't change a story. These are big old companies. And on that, then I did my intrinsic analysis. I did not change much. Just took the numbers from the 10K. And remember that when I talked about book value equity being negative for Philip Morris, here it comes. It's negative there. So it's been negative for the past 2 years. So basically, if this was to trigger some debt callbacks, this would be really bad because they don't actually have capital in the books. Let me just go to Philip Morris and show you. There they are. When you look at the balance sheet, their balance sheet here, you'll notice that stockholders deficient equity. They are short on equity. They are minus 10 billion short on equity. the equity is the amount which the shareholders actually brought in. And it's not a new thing. Even last year they were down 10.9, so they've reduced it by about 700 millions, not much. But they are down on stockholder equity. Back to my analysis. It's just, most of this was black numbers. I did some work on their R&D, which they expensed to take it back and capitalize it. Operating leases did the same thing. They have lots of off-balance sheet stuff. Where's their operating leases? They have some stuff off-balance sheet which I had to bring back into the balance sheet. So their debt was understated, but most companies do that. R&D, I also went back and added back that R&D which they'd expensed, capitalized it. And yeah. Their unlevered bet, I used the average for the tobacco companies. It's just about 4 of them. There's not much difference you'll get anyway. So that was my unlevered data, levered beta, which I used for these calculations. So net, the weighting on the cost of capital, you'll notice that it's about 79-21%, 79 equity, 21% debt. Much of this equity now you'll have challenges of saying, but I say their equity is negative. Yes, their book value equity is negative, but their market value is not negative, because the market value is this thing is trading at around 79, and these shares. So you multiply that by that, you get the actual market value, which is different from this, which is the book value, which I said is negative. And really changes which I introduced, which impact this analysis. Their their effective tax rate, they gave it as 40, but using my forecast going forward, I just dropped it to the new marginal tax rate, 21. Growth, I did not give them much growth going forward. Their current growth is based on this, on the last full financial year, was 4.2. I dropped it to 4. Operating margin currently is at, using these financials after cleaning them up, it's a 14.18. I dropped it to, I just left it there, and it's about 15. It's not much difference. And my sales to capital ratio, which I use for compounding reinvestment, I gave it as 6, and it's 5.9. So it's way above the market, the average for these others. But that's what I gave. I gave them what they have, basically. I haven't really tweaked it much. There's no tweaking there. It's just exactly what they have. Risk-free rate, I used the 2.8 for the US. Initial cost of capital is calculated on this spreadsheet, which I took you through. This one there, where I will attach the spreadsheet. So if somebody is really interested in the mechanics, you'll find it there, and you can tweak it also. It's not locked. And they have no options for employees. And basically, I did not do any tweaking here, because this is where damage usually gets done in evaluation. This can be changed big time. So I did not do much tweaking there. And yeah, with that, my value, basically also, when it comes to the growth, it grows at that 4% for the first 5 years. Then I start bringing it down to the risk-free rate, which is 2.8. And also the cost of capital, I started off with what they had for the which I calculated. This one, which comes from the from this calculation. My spreadsheet is not playing along. From these calculations based on the spreadsheet, which is 6.29, that's what I gave them exactly. And I went with that and dropping it gradually, no sorry, increasing it gradually to end up being just the risk-free rate plus 4.5%. That's what I worked off. So I really did not do much independent inputs to change things around. And yeah, that's just how it worked out. And I came to a value of my estimated value with my inputs of 96.27, while the current price is 80. So there is about a 20% margin of safety if somebody was to say, where is it now? Buying it now, if you are having a long-term opinion, you have some margin of safety there close to 20%, because it's actually trading below its intrinsic value according to me, and it's significant because it's about 80% of where the market value is. And this is the same thing which I got for Ultra. I'll just call it MO. It's a pain in the name. Ultra is a little bit better than PMO, PMI. So if one intended to go long, one would definitely be more on. If you are long and you want to be conservative, you rather go with more, and because it's even it's better, it's lower than PMI. But also on it, this thing keeps playing games on me. Its financials also, my estimated value is 71. The price is at 61, which is about 15% margin of safety if you are going long. I like this one better than Philip Morris if one is to go long. But personally, for me, I would definitely prefer PM because it's a better data, it's more volatile. But if there was to be trouble, these companies were actually going down and not coming up anymore, I would see a PMI going down quicker and dying faster than MO due to its debt and the way it's set up. It's a more volatile stock compared to the other one. And for me, trading my options, I would rather go with Philip Morris. And my personal take is that, let me not give my personal take, but I think this has dropped. If one is to, on the buying side, cigarettes are the thing to go with. But looking at the financials with this template of mine here a little bit, this is consolidating. Philip Morris is consolidating. I would stay on the side a bit and see how it goes, because I'm still expecting it to consolidate there. And remember, my actual price for Philip Morris is about 96, somewhere there. So this is not yet clearly going up. And MO has tried to go for it upwards. It looks like it's breaking upwards. It's a good take. My price is around here, 71, somewhere there. So this one is already moving. If one is intending to go long, one can start going into this one. That's just from the technicals, but I haven't done much on the technicals. But my strategy always, when I buy these things, I use back ratio, put back ratios, and call back ratio spreads to make sure that I can play when it's going up or down. So key for me, my analysis is that I want to make sure that the stock is not going to consolidate. That's that for my analysis, and I think this cigarette sector is the only sector which I have realized which has really been hammered lately, and one wants to go long, this is the sector to go in. But as I said, I'm always playing both sides of the market. I built my option strategy to benefit going long, to benefit going long. Reason is that I can put these options for a credit. So if I assume that this thing was to go up and I buy a back ratio call spread and it actually goes up, I'll benefit a lot. But if it actually goes down, I'll collect a small credit. It can tank all at once, but I'll collect a small credit, so I won't be hurt. And if I put both of them, the put and the call, either way, if it rallies going up on the put side, I'll collect a small credit and the calls will shine. So that's why I always play both sides of this market. You don't get more margin call, because once you put this one go up, you can only be right or wrong in one direction. But that's another video for another day of how I would set up my call spread. But my intrinsic value analysis is that I'm looking at the cigarette sector as having been greatly hit. That's one sector which I find to have its estimated value to be above the current market value. So do your analysis, check the cigarette sector, Philip Morris and Ultra Group, and see which one you're more comfortable with. But I will be back with this one once the financials are out. The year end for these ones is December. Expect the financials to be out around February. Then I'll do another detailed analysis. But in the meantime, I'll be in the market for Philip Morris. But it doesn't help anyone because I'll be in both directions. If you see this one not consolidating, if you see PM not consolidating, then you know I'll be making some money. If it consolidates around this 80 zone, I'll still get out within 3 months without being hurt. So in the next 3 months, I will be in this trade, but even if it consolidates, I won't get hurt. I'm going to take a 6 month. The calls which I'll be selling for the back ratio will be 6 months. The calls which I'll be buying will be a year. I'll do the same for the puts. So within 6 months, I won't get hurt at all. But if this one moves aggressive within that period, I will make some cash. That's Tusanang PM Sebata on analysis on the cigarette sector. I'm done. I'm out of here. This is one sector which is trading below its intrinsic value. I thank you. Bye-bye.